Welcome back to our channel, where we dive deep into the fascinating world of industry giants. Today, we're bringing you an exciting showdown between four major players in the tools and accessories sector: Lincoln Electric Holdings, Snap-on Incorporated, Stanley Black Decker, and the Timken Company. We'll break down their key financial metrics, explain what each one means, and compare them head-to-head to see who comes out on top. Get ready for a roller coaster of insights and numbers that will keep you on the edge of your seat. First up, let's talk about the price-to-earnings ratio. This metric tells us how much investors are willing to pay today for $1 of earnings from the past year. Leading the pack is Stanley Black Decker with a PE/TTM of 37.15, making it the most expensive relative to earnings. In contrast, the Timken Company offers the lowest price-to-earnings trailing 12 months at 12.44, suggesting it's seen as the most affordable. Looking at the PE 5-year average, we see consistency across the board, but Stanley Black Decker still holds the highest average at 16.42, while Snap-on has a stable 14.49. Forward PE shows potential future valuation, with Lincoln Electric at 20.22, indicating steady investor confidence, while Snap-on's 13.39 suggests a bargain for future growth. Moving on to the price-to-earnings growth ratio or PEG, which considers the PE ratio relative to growth. Lincoln Electric shines here with a PEG of 1.38, suggesting it's well valued considering its growth prospects. Snap-on, with a PEG of 3.76, appears pricier in terms of growth expectations. Something very similar happens to Stanley Black Decker with a value of 2.35, while the Timken Company's PEG of 1.64 indicates balanced growth and value. Next, let's consider insider ownership, which shows the percentage of shares held by insiders. The Timken Company tops the chart with a significant 10.09%, indicating strong confidence from within the company. In contrast, Stanley Black Decker has only 0.4%, showing less insider stake in the game. Profitability metrics are crucial for understanding company efficiency. Return on equity showcases how effectively a company uses shareholders' equity to generate earnings. Lincoln Electric leads with an impressive 44.94%, demonstrating efficient use of equity. Snap-on follows with 21.04%, while Stanley Black Decker trails with 8.35%, indicating room for improvement. Return on assets follows a similar trend, with Lincoln Electric at 16.49%, showcasing asset efficiency. Finally, return on invested capital highlights Lincoln Electric again at 28.46%, indicating excellent management of invested capital. And it's clear that SWK needs to improve their financial management if they want to improve and compete with their closest competitors. When it comes to the evolution of shares outstanding, Lincoln Electric is decreasing shares at a compound annual growth rate of 3.52%, potentially increasing shareholder value. The Timken Company is also decreasing shares by 2.67% CAGR, while Stanley Black Decker shows a flat trend with only a minus 0.70% CAGR. This commitment by the four companies to buy back their own shares is clearly a good sign, especially if they do so at current prices and not at historical highs. Continuing with earnings per share or EPS is another key metric. Snap-on boasts a solid $18.90 EPS, leading the pack. Lincoln Electric and the Timken Company follow with $9.52 and $6.70, respectively. Looking ahead, Stanley Black Decker is expected to see a significant increase with a CAGR of 15.82% over the next 5 years, showing strong growth potential. The evolution of earnings per share over the last decade shows Snap-on leading with an 11.42% CAGR, indicating robust growth. In contrast, Stanley Black Decker has struggled with a minus 9.20% CAGR, showing room for improvement. Next, let's talk about free cash flow per share. Snap-on again leads with a 15.95% CAGR in the last decade, highlighting strong cash flow growth. Stanley Black Decker, however, has seen a decline with a minus 3.35% CAGR, raising potential concerns about cash flow management. However, it is expected that in the next few years it will recover its previous free cash flow levels. For all you dividend lovers out there, starting with highest dividend yield, Stanley Black Decker offers a generous yield of 3.71% with quarterly payments of 82 cents. Additionally, over the last decade its dividends have grown at a compound annual growth rate of 4.94%, but recently this growth has slowed significantly, and now has a free cash flow payout ratio of over 70%, which can mean more debt issues and huge risk potential of dividend cut in the future. Secondly, Snap-on provides a solid 2.76%, with a compound annual growth rate of 15.53% and a quarterly payment of $1.86. In contrast, Lincoln Electric offers 1.44% dividend yield with 71 cents quarterly payments and 12.02% dividend growth over the last 10 years, so we have less initial yield and also less growth. Finally, the Timken Company offers a dividend yield of 1.63% and 6.83% compound annual growth rate. So indicates less initial dividend yield and also less growth. However, its free cash flow payout ratio is below 30%, indicating more dividend safety and a sustainable growth potential for the near future. When we analyze one company, it is essential to take a look at its margins. In this case, the operating margin is like the pulse of a business. Snap-on leads with 25.66%, indicating excellent operational efficiency. In contrast, Stanley Black Decker's 7.71% shows there's a lot of room for improvement. Profit margin follows a similar trend, with Snap-on at 20.06%, showcasing high profitability. Stanley Black Decker's 2.42% is respectable but not competitive in this group. The evolution of revenue and earnings over the last 8 years shows Lincoln Electric with a very positive evolution, reflected in its market performance. Snap-on and the Timken Company also show positive evolution, with similar total returns to the S&P 500 ETF, VO. However, Stanley Black Decker has a flat evolution, resulting in lower market returns as we can see in this graphic. Debt to EBITDA shows us how many years it would take for a company to pay off its debt using its earnings before interest, taxes, depreciation, and amortization. In simpler terms, it's like asking, how many years of my salary would it take to pay off my car loan? Stanley Black Decker is the most leveraged with a ratio of 7.30, indicating higher debt levels relative to EBITDA. This value is too high and any unexpected change can put the company in serious trouble. In contrast, the other three companies have more reasonable debt levels, that are below 3, indicating excellent financial management and health. Next, we have debt/free cash flow. This one tells us how many years it would take to pay off debt using the company's free cash flow, which is the cash left after all expenses, investments, and dividends. It's like asking, how many years of my leftover money after bills and fun would it take to pay off my loan? Stanley Black Decker also has a too high ratio, with a ratio of 10.29, but in this case the Timken Company has also a too high value. Both need to address its cash flow issues urgently if it doesn't want to emit more debt in the next few years. Fortunately, it is expected that during the next year it will skyrocket again. Snap-on and Lincoln Electric holdings are more balanced with ratios of 1.16 and 1.91 respectively, so both demonstrated that they are the most effective companies in managing its leverage. The average price return of the last 52 weeks shows all four companies experiencing declines, with the Timken Company at -11.18%, Lincoln Electric at -1.07%, Snap-on at -7.90%, and Stanley Black Decker at -7.98%. Despite these drops, all four companies have strong market positions with market capitalizations over $5 billion. Finally, analysts predict that in the next 12 months, Lincoln Electric's price could hit $219.56, representing an upside of 11.49% from its current price of $196.93. But hold your horses. Personally, I believe the fair value is around $196.30 after adding a margin of safety of 15%, suggesting it might be fair valued at the moment. Also for Snap-on, analysts predict an upside of 7.29% from the current price of $269.63 to $289.29, but for me a reasonable price would be around $277.95 after adding a margin of safety of 15%, which is between analyst price and current price, indicating a potential undervaluation and an excellent opportunity to add this company to our portfolios. For Stanley Black Decker, analysts predict a slight upside of 2.61% from the current price of $88.41 to $90.72, and for me a reasonable price would be around $62.90 after adding a margin of safety of 15%, which is very far from current price and suggests a potential overvaluation. This is due to its high debt levels and recent drop of its earnings and free cash flow per share. Finally, for the Timken Company, analysts predict that in the next 12 months, the price could hit $92.67, representing an upside of 11.16% from its current price of $83.37. But hold your horses. Personally, I believe the fair value is around $96.95 after adding a margin of safety of 15%, suggesting it might be undervalued at the moment. In my opinion, the Timken Company and Snap-on would be the two companies that I would consider as possible additions to my portfolio within the industrial sector. However, I would opt for Snap-on due to its high dividend growth over the last few years and a dividend yield between 2.5% and 3.5%, which is what I would look for in my portfolio. And there you have it, folks. An in-depth, head-to-head comparison of Lincoln Electric, Snap-on, Stanley Black Decker, and the Timken Company. Each company has its strengths and weaknesses, and now you're armed with the knowledge to make an informed decision. Which tool and accessories giant caught your eye? Let us know in the comments below. If you found this video insightful, don't forget to like, subscribe, and hit that notification bell so you never miss an update. Until next time, keep investing wisely.